Hello and welcome to the latest episode of the GI Huddle podcast. You may be more used to our one-on-one interviews recently, but today we're here for more of a discussion, more specifically a discussion on sports betting in a week of big news for the industry. Our guest today is Lee Richardson, CEO of Gaming Economics, an international advisory business, and co-host of the Big Betting Balagan, an industry podcast which launched earlier this year. With me as well is editor of Gambling Insider, Carl Friedman.
Hi, good afternoon. Lee, just wanted to kick in with, I guess the biggest news of the week, of course, is what's happening with William Hill and Caesars. Can you just run down how that deal has generally been received, how it came about, and has this been a big surprise, or did industry kind of see this coming?
Hi, Carl. Hi, Tim. Thanks for the intro. Yes, I think to some degree there was evidence of this being an ongoing deal. I remember there were two competing deals. There was Caesars, who already owned 20% of William Hill USA, but you also had Apollo Management. But I think the thing which probably got Caesars over the line was the fact that they made it very clear in their offer, and the offer I think was just about 2.9 billion, was that they were pretty much going to rip up the agreement they had, the access agreement that they had with William Hill. That was effectively a poison pill, and it was a very effective one because they appear to have obviously won that particular deal. But if you go back a little bit, remember that Caesars are only just recently coming off their own merger with El Dorado, and that alone was making them probably the biggest listed entity in the US. And certainly with access, both for land-based gaming and online across about 20 odd states. And obviously, as I say, Caesars were bringing that existing share of William Hill to the party anyway. Now, William Hill probably have around about a 30% market share of the US sports betting market. They've been there the longest. Certainly, they acquired their businesses in Vegas 7 or 8 years ago. And clearly had leverage, and they've leveraged that very, very hard. I think in the intervening period since PASPA was repealed 2.5 years ago. But Caesars have also made it pretty clear that they don't want anything other than the US element of William Hill. So we already know that the UK European retail and online businesses are going to be up for grabs. So effectively, this is the breakup of William Hill, not the brand, but the company. And we've already seen speculation, as you would inevitably expect, about, well, what happens to that non-US element of the business. We've already heard 888. They would be clearly interested in the online side of that part of the business. We've had at least 2 failed attempts, actually, of William Hill and 888 getting together in the past. This might be the final third time lucky, I guess, for 888 to get that. But I'm pretty certain they won't be interested in the retail side, of which, again, William Hill, major retailer in the UK with well over 1,000 shops, even though they've closed a couple of hundred on the back of COVID and FOBTs, etc. And again, we've already seen speculation that somebody like Fred Dome might want to pick those assets up. Fred is a very smart operator. I know Fred quite well. He stepped in back in March, I think it was, and bought a strategic shareholding when he realized just how cheap that 90-year-old William Hill brand was. And I actually went back and reread a post that I made on March the 17th. So that was a few days after the Cheltenham Gold Cup. And I noticed that William Hill had lost 90% of its value over the previous 5 years. And they were trading at about 36, 37 pence. And so their market cap had never been as small. And Fred bought a strategic shareholding at that time. Well, at the deal that was announced the other day, that's gone up around 8-fold. So he's made about an 800% return on that strategic acquisition. So you can see what Caesars are getting out from this, which is clearly going to be market share leadership on the online and retail sports betting business in the US. But the other components of the business are clearly going to be attractive. So whilst we'll see the end of the company as we know it, I can't see any of those potential or any other potential acquirers doing anything with the William Hill brand. It's the most well-known sports betting brand in the US, despite lots of other people entering the market, DraftKings, FanDuel. There's no question that William Hill has real brand equity in the US, as it does in all the other markets in which it operates. So I don't think this is the end of that 90-year-old betting brand, but it's certainly the breakup effectively of the company. I think that's the case.
What were the you said that this would be kind of the third time that they go into talks with Triple Eight. What would have been the sticking points there?
I think it was always price. I think it was always William Hill doing the acquiring, and it was always a too high a price. I think the first time, I'm trying to remember, there was one or two occasions when William Hill were going to float and then they pulled it at the last minute. So I can't actually recall whether the first exchanges were before they were a listed company, but certainly one of them was when they were listed, and the price just wasn't right. So this, in a sense, is a reverse of that. It may be William Hill who this time don't get the price right, but that was always the sticking point in the past.
Yeah,
we talk about kind of how this deal affects benefits Caesars and affects the you say the William Hill brand will continue. How, Lee, do you think it shakes up the US market in terms of kind of the brands you mentioned, like the DraftKings and FanDuel, who've got that early kind of lead in some markets, but also how does it kind of compare Caesars now with like against an MGM when they've got this kind of additional brand now?
Yeah, I mean, one of the interesting things is I've been spending quite a bit of time this last few months examining what sort of market shares people already have and what they aspire to. And you've still got new people coming into this market in the sense as listed equities, so listed entities rather. So, for example, Rush Street Interactive are going through a special purpose acquisition company route, and you can see what they're hoping to get share of the US sports betting market. If you look at all of their aspirations, it comes to well over 100%. So clearly there are going to be some winners and losers. I think MGM have probably been through Raw Digital, which is the joint venture, GVC and MGM. They've probably been the most aggressive, saying they're really going to spend as much as it takes to get like a dominant 20% plus market share. DraftKings have pretty much a similar strategy, as does FanDuel, and you have many other smaller providers in there. So there are clearly going to be winners and losers. And I suppose at this stage, here we are in October 2020, it's probably William Hill, actually, through the Caesars as the market leader, most people would have, that are probably going to come under the most pressure. I think we talked about the William Hill acquisition on a podcast with the colleagues I have at Big Betting Balagan, and one of our co-hosts, Vine Kozacek, was with William Hill when they acquired those businesses a few years back, and is very familiar with their technical setup. And I think one of the challenges and one of the differentiators is going to be is who's got which platform is going to be the most agile and the best place to take advantage of what is a fast developing, fast moving marketplace. Because I think it's fair to say that if you look at the mobile apps that are currently out there available for sports betting in the US, they're not particularly leading edge. They are pretty clunky in many cases. And whilst mobile is still getting the lion's share, as you would expect, there is still, I think, an opportunity for somebody to bring an absolutely first generation sports betting mobile app. I don't think it exists yet in that marketplace. So you can clearly see that whether it's Raw Digital, whether it's DraftKings, whether it's William Hill or some of the others, there's definitely an opportunity to get real market share and scale and scope by improving that offer to the US consumer. And Rush Street Interactive, for example, are very clear that that's where they see an opportunity, and that's why they think they're going to get a 6 to 10% market share once they attack that beyond Pennsylvania and New Jersey. So it is all to play for. I know that's a bit of a cliche, but there will clearly be winners and losers because they can't all get the market share they've already stated that they want, because it just doesn't exist. Adds up to more than 100%. And even up my basic maths understands that aspect.
So is this kind of a gold rush in the US right now?
I mean, gold rush in the sense of getting players and getting revenues, I would say it probably is. Again, we've got to remember that probably still 80% of all the bets struck on sports betting in the US right now are still with the offshore illegal market. The legal market is still getting the vast minority, but you are seeing very good year-on-year growth, even taking out the COVID effect, which clearly interfered with sports earlier in the year, but is much less so now, as we know. You're seeing growth at every single level, whether it's small markets like Rhode Island, which is probably the smallest live legal sports betting market, right through to the larger, more established ones like Pennsylvania and New Jersey.
Right.
But the other aspect to remember again is the really big markets, the likes of New York, the likes of California, the likes of Texas. These are huge markets where at the moment there is nothing available. And I think for the real gold rush, we have to see one of those mega states come on board and adopt, much in the way that we've seen it successful, particularly in Pennsylvania and New Jersey. We've got to see that before we see a real breakthrough in sheer volume terms, and to get a chance of the legal market even getting to 50% of the total market right now.
Do you see momentum going in that direction? I mean, with the election coming up in November, do you think that'll be a pivotal marker in terms of which direction it'll go?
I've read various people's views about what impact this current election will have on that. I'm not entirely convinced it makes that much difference. I think what's been much more important has been the dramatic effect on state budgets through the pandemic, and we've already seen evidence that people are bringing forward. Michigan would be a classic example, bringing forward legislation expanding into iGaming. We can touch on iGaming maybe a bit later and the impact that has with sports betting. So I think the state of states' finances and political requirements over their individual budgets is going to have a much more significant effect. And I can see that being much more of a reason why California would adopt this. We know, for example, they missed out on the opportunity of having their referendum at least until 2021, and 12 months away before we even get close to that. So we've missed this year that opportunity. But I can see other states bringing those things forward, and I think that'll have a much more of a significant effect on the political side, because many of them just have huge gaping revenue gaps, and clearly some of these things can help plug them to some degree.
Yeah, you mentioned sort of those key states, so like California being an example. If I may, like sort of kind of a hypothetical at you. Let's say, it legalizes, best case maybe in a year or two. With taking it back to the William Hill deal, who do you think kind of is in the best position? Let's say a big market like that opens up to kind of go straight in there and dominate it. Is it Caesars with William Hill now, or is it still going to be very, very tribal based in California, or who do you think kind of would at this moment hypothetically lead the way there?
Yeah, you're absolutely right to raise the tribal influence. There are a couple of key states. California would be one of them, Oklahoma another. I think because of the number of tribal outlets, and they would be a very powerful lobby to whatever would be allowed and available in California, you would have to say that some of the land-based, and Caesars and William Hill would certainly be in this category, would be very well positioned to take advantage of those multiple deals to cover the multiple outlets and facilities that the tribal operations have there. But we would absolutely expect to see the likes of Penn Gaming, who have just entered the market, but they have a very, very clearly self-stated, we will go every single state that we can have operations in, we will. DraftKings have a similar operation, so do FanDuel. You've got now multiple operators who have the similar strategy of wherever they can be available, they will go for licenses. So you can imagine it being extremely competitive. It'll be interesting to see exactly what kind of setup California would adopt. If they go for a free market model, yes, it could become one of the most competitive markets in the entire in the entire US, and you would expect that in an economy which, if it was a separate country, would probably be the fifth or sixth largest economy in the world.
Oh, yeah, that's okay. That certainly makes a lot of sense. Where do a company like, I know William Hill kind of is the big kind of news this week, but where do someone like a Bet365 come into the picture? Because obviously elsewhere in the world, they usually take a very leading position. In these big states in the US in the future, kind of where do you see them playing a major part?
Yeah, again, great question, because I think there are operators who have been early into the US and some later, and I think Bet365 clearly have been later than some. I see they've just agreed a deal, I think, in New Jersey with Playtech. It's one of their early clients. They're clearly testing the water. They clearly have the resources. They clearly have the backup and the opportunity to go wherever they would wish to. I think it's fair to say, though, that those companies who have clearly had operations in other grey revenue markets may have difficulties, or more difficulties than others, in getting licenses. But we know that places like New Jersey are pretty thorough. They have one particular view about how they treat people who have had grey revenues in the past, and they've redefined what grey revenues have meant in the past. So some operators are going to have that to deal with before they attack multiple states. But you can't see why a company like Bet365 couldn't enter states where they would choose to and be very successful, because they've done this multiple times in multiple markets, and you would expect them to have the same opportunity in the US. I think another aspect, which again clearly we've started to see, is the importance of iGaming, and we all know the importance that when you have iGaming plus sports betting, that can be much more lucrative to the operator and to the regulator and the tax revenue yield. And I think if COVID has seen anything at all on this aspect, it's what's been happening in Pennsylvania and New Jersey in the last sort of 6 to 8 months. So if you remember, New Jersey have had iGaming for about 5 or 6 years. Pennsylvania launched it in the summer of last year. So if you go back to December of last year, so just 8-9 months ago, the total gross win revenue forecast for those two markets on a 12-month sort of forecast basis was about 700 million. Excuse me, about 700 million back in December. By August, that's risen to about 1.7 billion. So the COVID effect in that market has been absolutely huge, and that's not going away. That's not a temporary factor. I think that's pretty much permanent, and that's just from 2 states. We're starting to see, I think it's available and legal in 5 states now. Places like Delaware, pretty small, but Virginia are coming on, Michigan are coming on. And I think estimates of 2 billion a year from those 2 states is quite reasonable, and estimates for the US across the piece of between 10 and 15 billion in gross win from iGaming alone, I think are pretty reasonable based on the experience we've seen in those 2 states, as I say, in the last few months. And what I think we will see is those operators who are particularly strong in iGaming and sports will take full advantage of this. So that, I think, does give particular advantage to the likes of Bet365, to the like of Raw Digital, to the like of William Hill, perhaps versus some of the mostly soulless sports betting entities, perhaps like DraftKings. But that will be interesting to see how that plays out. Certainly.
Is there a danger of getting back to Caesars? Is there a danger of getting too big and having too much influence?
I'm not sure you can ever really be too big unless being too big makes you slow and inefficient. There's always a danger of that. I think what's interesting about the Caesars deal is, in a sense, no sooner have they had the approval for the El Dorado merger, is that they're acquiring a third leg. And there's no question that that's going to be a tough integration to make that as quickly and as smooth as possible. And one thing we are seeing, and this will be interesting to see what actually comes to Caesars on the back of the William Hill acquisition, because people are always an incredibly important part of that, is one cloud I do see on the horizon is what I would call a talent gap in the US, particularly on the sports betting side. There is a real gap between demand and supply of really good proven experience, whether it's trading, marketing, operations, and leadership. And I mean, one small example, no names, no pack drill, but one tier one operator has appointed a new leader for that business, and that person isn't yet able to relocate to the US. That person can't actually be in market leading that operation. They're having to do it remotely. Now, we've all become much better at working remotely the last 6 months, whether that's tech teams or other teams, and I think the industry's pivoted really well on that. But in a sense, that can become, you do that because you have to. It's almost like an emergency. If you don't pivot, you're in real trouble. Whether you want that to be a permanent feature of how you operate because it's more productive and because it's cheaper, that's another thing entirely. And you do have to re-engineer organizational structures and communication channels to do that if it's a long-term, permanent, this is how we operate type of solution. So at the moment, I do see if there's one drag on the potential growth, I think is that talent gap. And if Caesars can overcome that because they can cherry pick across 3 businesses now, William Hill and Caesars and Eldorado, then that could put them in a really good position to take full advantage of where they are today, because they know some of their competitors might find that difficult. So there is, I think that is a real issue and a real strategic challenge both for existing and incoming businesses. It's not easy to pick up your really good people from around the world and relocate them to the US. It's very hard to get visas for any of them or all of them. And I know for a fact some people were up until the pandemic stopped travel, were sailing pretty close to the wind in terms of what they were actually doing when they came to the US, and sailing close to the wind with visas and so on. And that's obviously stopped because of the lack of travel. But long term, I think, or short term rather, it's definitely an issue. And I think longer term, until there's some solutions like pivoting on how you structure or giving people more flexibility about how they actually gain visas to actually get in market to manage the businesses.
Yeah, I think there's a sort of key points you made there, and I think Carl's question was an important one, because, like you say, I suppose you can never be too big. But on kind of off the back of that, to dovetail it a little bit, seeing as, like you said, Caesar, I was surprised that Caesars and Eldorado, only really just was confirmed very recently, and suddenly this pretty quickly came together with William Hill. I mean, is there going to be even more M&A in the market, but maybe perhaps even within that firm in the future?
Well, clearly, yes. We touched on some of they've always said the bits of the business they don't want, so we can certainly see M&A resulting from the non-US operations. I think within the US, we're certainly seeing a lot of activity on these so-called SPACs, these special purpose acquisition companies. I think DraftKings, were the first to do that, probably one of the biggest. I know the activity level generally in the market in the US has been huge. I think there's been over 100 of these, including ones obviously in our sector. So I think things like Golden Nugget, who are the #1 in iGaming by far in New Jersey, they've just hived off the iGaming sector and they've gone for that. That's GNOG, I think it's Golden Nugget Online Games. We can definitely see, I think, more examples of that. I can see some of the smaller operators being acquired. I mean, one small example, we talked earlier about UK and European suppliers, people like Playtech perhaps, Canby, excuse me, and SB Tech have all done very well in the first 2.5 years of the operation. Yeah, so I was just saying about European, UK suppliers. I think some of the smaller ones also will become of interest to people. So At the other end of the extreme, there's a small AIM-listed business, Gaming Realms. Now they've trebled their market cap in the last 6 months since before COVID. They now have more of their business overseas than they do in the UK, and their biggest market is the US, and they've been growing very quickly there on the back of their IP they own with Slingo. They say their market cap has trebled. They're getting business in Pennsylvania, New Jersey, and elsewhere. They've gone from EBITDA negative to positive. They think they'll be cash flow positive. Those sorts of operators are doing very well from the growth in the US. And you can certainly see larger companies being interested in acquisitions of companies with that sort of profile. You've got smaller platform providers like FSB who are looking to move into the US because of other pressures, I think, in the UK and Europe regulatory, we know very well. So I think there will be more mergers and acquisitions at every level, whether it's operators or whether it's suppliers, and suppliers, whether they're tier ones, tier twos, or smaller. I think that goes without saying, because people will be looking for creativity, not just in market access and coverage on sports betting, but they'll be looking for something to differentiate them on the iGaming side. And that's where I say smaller operators have got that ability to compete, and they're doing that very well currently, I think.
Of course, the big unknown right now is how the pandemic is influencing everything. How much is that going into decisions companies have to make now, with getting revenues back up to acceptable levels, and is there, what kind of mitigating strategies do you think are most effective right now?
Yeah, I mean, clearly lots of heavily land-based, retail-focused operations and businesses are clearly taking a much bigger hit. And I think anyone who is overly exposed is clearly going to take longer to get back to normality.
Yeah.
Excuse me.
That's all right.
And some of those, frankly, probably may not make it. They may have to shed a lot more jobs. They may have to let a lot of operations go. I think that's still a risk if you're overly exposed to retail in the US. I think those companies who are already have pivoted very well are those that have maximized the digital offering. Goes with it, has become absolutely essential. I mean, I think the sort of retreat of retail is just going to accelerate going forward, and whether that's iGaming or sports betting or even on the lottery side. I mean, extraordinarily, when you've got a pretty big lottery business in the US, it's remarkably how little is actually done online. I think it's less than 5% of every dollar that is spent. It comes through an online or digital format. That's partly because the sort of retail lobby is very strong, and it's gas stations and convenience stores and liquor stores where most of the transactions and tickets are bought and sold. Now, the demand for iLottery or online digital of the lottery, I think, is now at an all-time high. And in some cases, you have to completely change the business model, but there's real pressure for that. And I think for the lottery to really compete post-pandemic, this could be a good thing for them because it will make them more efficient. We all know it's more efficient to take a digital transaction rather than a retail one. So I do see real opportunities there for lottery to take advantage of what the pandemic has brought, because they're all suffering from lower sales because they don't have an easy digital option for most players in most states.
Yeah, I mean, what you, just getting back to what you were saying at the beginning of the conversation about William Hill's retail side, how is that an attractive venture for potential investor or buyers?
It will be challenging. There's no question. You could argue that all of the weaker performing shops have been shed. I think William Hill shut down about 190. And I know how how Fred's business operation and business model operates. He would be, I think, very shrewd and very binary in which one of those he would want, which one of those he thinks he could make an adequate return from. But it will be tough. We know we're looking for a smaller and smaller retail footprint in the UK. I've visited shops since the reopening of shops some weeks ago, and in every single case, they are always much quieter than I would have anticipated or expected. And these are the ones that have reopened. So it is difficult, and you would have to think that the estate will continue to decline in the UK. It's around 8,000 and declining on the back of COVID, on the back of the FOB-T changes. And yes, you are looking at a smaller estate, but I think the quality of those will be what Fred would, as an example. There will be other acquirers, perhaps Boyle Sports might be interested in some of those to expand their UK retail footprint, but they will always be looking without question at the quality end. I think the marginal shops are always going to be under pressure, and this deal is going to accelerate that, I think, Carl.
But yeah, no, we've covered some really good ground in terms of the iGaming, sports betting, the US market. But I guess, Lee, it would be a good time to get maybe your what would your summary be of this Caesars William Hill deal in the sense of how big of a win is it for them? Not necessarily as basic as out of 10, but what is the kind of the main takeaway point you think, and the rest of the market will sit up and think, right, this has happened and this is what it means for us.
Yeah, okay. I think it's very ambitious. I think it will be a tough integration, but they certainly are buying market share leadership. They can exploit that. They can definitely get an advantage, I think, if they cherry pick the talent they've got within the expanded operation to leverage that. And I think it will become difficult for some of the smaller entries and some of the major markets. You can see that with the market share they would have and the profitability they can generate, but they would clearly be looking to leverage that in the states like New York, like California, like Texas. So I think that puts them in pretty good position. I think the pressure for them will be on the integration of that. How quickly can they do that? Can they take advantage of that position? And I think for other people, yes, it shows that deals can be done, and it doesn't matter at any stage whether it's smaller down the scale. We mentioned about smaller iGaming providers will be of interest to people, right through to 90-year-old brands that have got market share leadership positions, and there's opportunities, I think, right across the piece. But yeah, they're going to be the number one largest operator. They're there to be shot at. The number one always is, and I guarantee that there'll be countless operators trying to do exactly that, to chip away at their market share leadership position.
Talked about suppliers, operators, iGaming, sports betting. So I think, hopefully our listeners have gained a lot from that. And Lee, thank you for your time, because you gave us a lot of good insight and analysis.
Not at all. Enjoyed it. Okay. Thanks, Carl. Bye.
Have a great day.